Silver market crisis. The complete story. Or this honestly, what if I told you the number you see right now isn't real? Because while most Americans are staring at a silver price around $70, wait before you look at the silver price on your screen and announce. Something shocking is happening quietly across the world. In parts of Asia and the Middle East, buyers are paying nearly double for the exact capital pressure transported to the expensive market, pocket the difference, and the price gap disappears within days or even hours. But silver isn't correcting, it's breaking. And the longer this persists, the more violent the eventual correction will be. Why is this happening? Because the world's largest supplier just slammed the door shut. At the start of 2026, China quietly implemented the strictest silver export controls in modern history. Overnight, roughly 2/3 of global refined silver production became restricted. Only a limited number of approved exporters are now allowed to ship silver out of the country. And even they face quotas, delays, and heavy oversight that makes exporting Chinese silver nearly impossible. This wasn't gradual. There was no multi-year phase-in period. There were no warnings to international buyers. It wasn't announced at global economic forums. It was immediate. January 1st arrived, and suddenly the rules changed completely. China controls a massive portion of the world's refined silver, more than the next 5 countries combined. When that supply was suddenly locked down, the shock didn't show up on American trading screens immediately, but it exploded everywhere else. Manufacturers in Europe who need silver for industrial processes. Electronics producers in Asia who can't build semiconductors without it. Solar companies in the US who require silver paste for every panel they install. All scrambling for the same shrinking pool of metal. And the problem compounds daily because silver isn't like oil where you can just drill more wells quickly. Silver mining is a multi-year process. You can't snap your fingers and increase production 30% to compensate for Chinese restrictions. And now, let's talk about the part most investors don't understand, the structural architecture of silver markets themselves. The US futures market, where silver prices are discovered and broadcast to the world, is backed by a surprisingly small amount of actual metal. Only a fraction of what's traded on paper can ever be delivered physically. The leverage ratio between paper claims and physical metal is staggering. That's not a conspiracy theory. That's not some internet rumor. That's how the system is officially designed and has operated for decades. Most traders never ask for delivery. They're not buying silver to hold it. They're hedging price exposure, speculating on directional moves, managing portfolio risk. They settle in cash when contracts expire. The system works smoothly as long as no one actually needs the metal itself. But that fundamental assumption just failed catastrophically. Recently, delivery requests surged to levels that shouldn't happen in a healthy market. Now, we're not talking about 5% of contracts demanding delivery, which would be considered normal. Not even 10%, which would raise eyebrows among exchange officials. We're talking about massive claims on available inventory, levels that would have been unthinkable just months ago. And instead of prices exploding upward like basic supply and demand economics would predict, prices barely moved on the official exchanges. Stop and think about that for a moment. Supply is vanishing behind Chinese export restrictions. Demand is surging from industrial users who can't source metal anywhere else. Physical buyers are paying premiums of $50, $60, even $70 per ounce above the official price. Yet the futures market price stays remarkably calm, remarkably stable, remarkably disconnected from physical reality. That only happens when the paper market has become fundamentally divorced from the underlying asset it's supposed to represent. And now comes the part that should make every serious investor pause and reconsider their understanding of precious metals markets. Because while retail investors argue on social media about whether silver will go up or down, the biggest financial institutions in the world have been making very different moves, quietly, methodically, and with enormous conviction. Over the past several months, one of America's largest banks did something that almost no one in the mainstream media noticed or reported. They eliminated a massive short position they had held for years, a position that made them money every time silver prices fell. We're not talking about a minor adjustment to their derivatives book. This was the complete reversal of a multi-year strategy. At the same time they were closing those shorts, they were accumulating enormous amounts of physical silver on the other side. Not contracts that could be settled in cash, not derivatives that offered price exposure, actual metal sitting in allocated storage facilities, hundreds of millions of ounces. Possibly the largest institutional stockpile of physical silver in modern financial history. That's not hedging. That's not diversification. That's not standard risk management. That's positioning for a specific outcome. That's betting the house on a particular scenario unfolding. And then they did something even more interesting. Something that reveals exactly what they believe about timing. They loaned a huge portion of that silver overseas with a contractual return date right as global supply tightened and export restrictions kicked in. Right as delivery pressure on exchanges was intensifying. Right as physical premiums were exploding. Think about what that signals from a strategic perspective. You do not demand hundreds of millions of ounces of metal back at the worst possible time for global supply unless you believe that metal is about to become far more valuable than current prices suggest. You don't position yourself to control massive physical inventory right when shortages are most acute unless you know something the market hasn't priced in yet. This is how the smartest money in global finance operates, not with predictions, not with hope, but with cold mathematical analysis of supply, demand, and market structure vulnerabilities. History gives us crucial clues here about what happens next. Whenever physical metal is truly demanded in large quantities, not promised, not rolled over into future contracts, but actually demanded for delivery, something breaks in the paper markets. Lease rates spike violently as institutions scramble to source metal. Refiners halt operations because they can't get raw material. Emergency rules appear from exchanges. Cash settlements get offered instead of physical metal, often at prices far below what the physical market is actually trading. But the screen price barely flinches during these stress events. It stays remarkably calm, while the entire plumbing behind it creaks and groans under pressure. And exchanges respond the same way every single time throughout history, by raising margin requirements. Margin hikes aren't really about protecting traders from excessive leverage, though that's the official explanation. They're about reducing delivery pressure on the system. They force weaker hands to close positions. They discourage new traders from opening contracts, especially those who might actually demand physical delivery. It's the emergency brake, the circuit breaker. The mechanism exchanges use when they fear they can't handle the delivery obligations they've created. What's profoundly different now compared to historical precedents is the timing of these moves. In past silver crises, 1980 with the Hunt brothers, 2011 during the last major rally, margin hikes happened after prices had already exploded to multi-decade highs. They were responses to obvious speculative bubbles that had inflated dramatically. This time, margin increases are happening while prices still look relatively calm on the surface. While silver sits well below historical highs, while mainstream financial media isn't even talking about precious metals, that tells you everything you need to know about what exchange officials are seeing in their delivery data, their inventory levels, their open interest calculations. They're pulling the emergency brake before the crisis becomes obvious to everyone else. They're trying to reduce future obligations before more contract holders wake up and demand physical settlement. Now let's talk mathematics, because this is where theoretical arguments end and cold, hard reality begins. The total amount of silver promised on paper through futures contracts far exceeds what can actually be delivered from available inventory. Multiple claims exist for every single ounce of registered metal. That system only works when people trust the promise more than they demand the metal itself. But trust disappears remarkably fast when physical shortages become obvious and undeniable. If even a modest percentage of contract holders, not everyone, just a reasonable fraction, suddenly demanded physical delivery instead of cash settlement, available registered inventory wouldn't be enough, not even close. The math simply doesn't work. We're talking about leverage ratios of 5 to 1, 6 to 1, maybe higher, 6 paper claims for every ounce of deliverable metal. And when exchanges can't fulfill delivery requests because inventory is exhausted, they're legally allowed under their own rules to settle contracts in cash instead, at the paper price shown on screens, not the physical market price where metal actually trades. That's the moment when investors realize they never actually owned silver. They owned price exposure. They owned a financial derivative. And exposure is fundamentally not the same thing as ownership. Once that realization spreads through markets, once enough traders understand the difference between paper claims and physical metal, the entire pricing structure changes permanently. Industrial buyers don't care about futures market theories or exchange rules. They care about keeping factories running. They care about maintaining production schedules. They'll pay whatever it takes to secure physical supply. $100, $150, $200 if necessary. Investment buyers don't care about complex financial models once scarcity becomes obvious. They care about owning real assets. They care about protection against currency debasement and system instability. And scarcity doesn't negotiate. It doesn't compromise. It reprices assets until supply and demand balance at a new equilibrium. This is exactly why physical premiums matter more than screen prices right now. They tell you where real demand actually exists. They tell you what people pay when they need metal delivered, not when they're just shuffling paper contracts. They tell you the truth that official exchanges don't want to acknowledge. Silver isn't being repriced because of social media hype or speculative fever. It's being repriced because 5 consecutive years of structural supply deficits just collided head-on with sudden, massive export restrictions from the world's dominant supplier. And that collision doesn't resolve gently or gradually. Markets don't calmly reconcile $60 price gaps between paper and physical. They don't slowly adjust over months or years. They snap violently. They gap up overnight. They leave people who were positioned incorrectly absolutely stunned. When paper systems repeatedly fail to deliver physical reality, price discovery doesn't stay with those paper markets forever. It moves to venues where physical metal actually changes hands and where prices reflect real supply and demand. And once that shift happens, once the world starts looking to physical markets in Shanghai or Dubai or Tokyo for real silver prices instead of New York futures, that shift doesn't reverse. The old system doesn't regain credibility. It doesn't gradually win back trust. It becomes irrelevant. This isn't about predicting a specific price target next month or next quarter. It's about understanding structural breaks in market architecture. It's about recognizing when fundamental assumptions that markets are built on start failing. The assumption that paper equals physical. The assumption that contracts will always be honored with delivery. The assumption that official prices reflect real-world supply and demand. When those assumptions break, everything built on top of them gets repriced, fast and without mercy. If you've made it this far in the video, comment below and tell me where you think silver pricing truly belongs. Should we trust paper markets or physical markets? I genuinely read every comment, and this discussion matters more than most people realize. Also, please share this video with anyone who still believes screen prices always tell the complete truth about markets. Share it with friends who invest. Share it with family who hold retirement accounts. This information matters. Because once the adjustment happens, once paper markets either close the gap or lose their relevance entirely, it won't be carefully explained on the evening news with graphics and expert panels. It will simply be accepted as what happened, as the new normal, as the way things are now. And those who understood the dynamics early, who saw the structural breaks developing, who positioned before the crowd realized what was occurring, they won't be surprised at all. They'll simply be prepared for a reality that others are still trying to understand. The mathematics are clear. The positioning by sophisticated institutions is obvious. The timeline is compressing. And the largest disconnect between paper and physical pricing in precious metals history is approaching its inevitable mathematical resolution. Whether exchanges are ready to admit it or not. Chanel Neem.